Determining capital structure in practice. This includes certain fundamental guidelines in terms of structuring long-term finance sources, includes equity shares, ordinary shares, term loans, debentures, and instruments for hybrid financing. So there is long-term finance and there are internal sources and external sources of long-term finance. Internal sources may be depreciation charges and retained earnings. External sources may be equity shares and ordinary shares, term loans and debentures, and instruments for hybrid financing. So let us first take a look at what is long-term finance. Long-term investment decisions mostly end up in the acquisition of long-term or fixed assets that get financed with long-term sources. Mainly the sources are internal sources like depreciation charges and retained earnings. And external are equity capital, term loans and debentures, and instruments for hybrid financing. So let us first take a look at what are internal sources. Internal sources may be depreciation charges and retained earnings. Let us see what is depreciation charges. Depreciation charges replace concerned assets which are mostly fixed assets which are subject to depreciation every year. The only internal sources for this type is retained earnings and as such are one important long-term financing method. Retained earnings. Retained earnings are a source of long-term financing. They are available to the firm. All potential problems one could think about by external equity financing can be avoided in this case. Existing shareholders remain and there is no dilution of ownership when a company adopts this method. In terms of dividends foregone by shareholders which make up this method or the retained earnings, this has higher opportunity costs. Next is external sources. Among external sources, the important ones are equity and preference capital and represents ownership securities and loan capital respectively. Firms who are in requirement of long-term funds from external sources obtain them from capital market. The main sources of capital market funding is equity shares or equity capital, then debt instruments or debt capital, and hybrid instruments or hybrid sources. We will examine each of them in detail. Equity shares and ordinary shares. Equity share capital is also called ordinary share capital since in contrast to preference shareholders, have no preferential or prior rights in regard to income or its redemption. As the need for financing increases for a company, it first issues equity capital to its promoters. When the need for financing still increases, the company may issue ordinary shares to its promoters, relatives, friends, business associates, employees, mutual funds, and financial institutions. As the company grows again more, it raises capital from the public in form initial public offering or IPO, which is the first issue of equity shares from an unlisted company. Subsequent offerings are also called further issues. Now, next is term loans and debentures. Term loans are also known as project finance or term finance. The primary sources are financial institutions like IDBI, ICICI, and IFCL and provide loans to corporates. In a limited way, commercial banks also provide term loans. These financial institutions provide project finance for new projects for expansion and diversification, whereas most of the term loans extended by these banks close the working capital gap in the borrowing institutions. Covenants are reinforcements made on asset security stipulation by the financial institution in order to protect their interests. Positive and negative covenants exist in terms of what a borrower should or should not do under loan agreements and terms. Similar to promissory notes, there exist debt instruments called as debentures, where debenture holders are long-term creditors of the company. As a secured instrument, it is a promise to pay interest and repay principal at specific times in the future. When in comparison, the equity capital gets variable income in the form of dividends to the equity holders, whereas the debentures get the debenture holders fixed income interest as security. Next is instruments for hybrid financing. Hybrid sources of financing has characteristics of both debt and equity financing and falls somewhere in between. The important hybrid financing instruments are preference shares or preference share capital, convertible debentures or exchange bonds, or warrants. And actually warrants. So let us see what each of them means. Preference share capital is type of long-term financing and combines features of equity and debentures. It is similar to a debenture because it has fixed income, interest or rate. It ranks as a claimant a level higher than the equity holders. It normally does not have voting rights and does not have a share in the earnings of a company. Convertible debentures or exchange bonds give the holder a right to convert them to equity shares on certain stipulated terms. Until the debentures or bonds are converted, they enjoy fixed income interest rates on their instruments, and after conversion, they share the benefit which are normally associated with shareholders. Warrants, on the other hand, gives its holders to subscribe to equity capital of a company during a specific period at a stated price for the offer. The holder normally acquires the right to own shares, which is an option, and has no obligation to acquire the shares. Normally, it is issued in such a manner that it stands associated in conjunction with other instruments like notes or debentures. Warrants have exercise price, which is price at which holder can exercise acquiring ordinary shares, exercise ratio, which enables the holder to acquire a specific number of ordinary shares, and expiry date before an option can be exercised. So this completes determining capital structure in practice. Thanks.